Might just have to just, you know,
Oh, it
take it
says
on
it's
faith.
recording. Never mind.
Okay. Okay. There
Yeah.
we go. Okay, good. Okay. So I'm just going to launch it and then we can just chat, about this. That's all I'm thinking about doing. And this is literally just whatever conversation we would otherwise have. We'll just have it. You know what I mean?
Makes sense.
Okay, good. Okay. So, welcome to a special edition, maybe the first of many of this sort, if they're not unreasonable podcast. So, my guest today is Michael Tanzer, portfolio manager at Callaway Capital, and author of a newsletter I read every week called STROTW. I don't think it's meant to actually spell something as an acronym does, stuff to read over the weekend. This newsletter is pretty old school. It looks to me just an email you literally send to people with a BCC list. Is that right?
That's right. Yeah.
And they can sign up by emailing you. And you wanted to give your email out?
Sure. It's MIT@CallawayCap.com.
Pretty cool. Okay, so Michael, we've known each other a little while now, and you emailed me to catch up about all things COVID-19, I think, especially the way it impacts the insurance industry. I thought it might be an excuse to experiment a little bit with my own personal educational journey here, because this is something I'm thinking about a lot. I don't know how to think about it yet. I think the world is going to change in some ways. Some of them are going to be permanent. Some of them are not. I know I want to figure out for my own personal and professional purposes where the puck is going so I can skate there. But let's just have our conversation. So hit me with a question, Michael.
Yeah, sure. So I guess in podcasting, you're not really supposed to timestamp the interviews. But
No, we
I'm
should
sure
though. This will be different.
I think that
So
one of
Sunday
my
morning,
favorite.
11 a.m., March 22nd. There's our timestamp.
That's right. And I think, one of my favorite books about the financial crisis is this book. It's called Diary of a Very Bad Year. It's actually put out by this Brooklyn-based literary publisher, and they basically got some portfolio manager at a multi-strategy hedge fund to do a series of interviews over the course of the financial crisis.
During the crisis.
During the crisis, yeah.
Oh, that's
And
interesting.
so it's interesting because the guy is obviously super smart, but clearly gets a lot of things not exactly right and some things wrong, and you get that palpable sense of uncertainty and fear of someone who's obviously very keyed in. So maybe we'll channel a little bit of that today.
Yeah, great. I'm going to write that down. I hadn't heard of that book. That sounds awesome. That is exactly what I'm trying to do.
Yeah. So I guess before you just launch into hypotheses of magnitudes or whatever, lines of insurance you think are particularly susceptible to whatever is going to come. I mean, in general, do you have a model of cycles in the insurance industry that you kind of adhere to or implicitly believe personally?
So, I mean, I think as usual, at least in the sense of I don't see many other people who say these kinds of things, but I believe in the old-fashioned price signal. And so I think that to the extent that prices go up, that is a indicator of surprise. And so you just come back to the insurance industry is a forecasting machine. And to the extent that the prices are going down, it means that people believe that everything is good. And when prices go up, they believe everything is bad. And I'm kind of an efficient markets person in the sense that I think that those prices do incorporate all the knowledge of the future. So, under that model, it's when you have an exogenous shock of some sort, something people didn't see coming from before, and that causes a real problem. And I think that, I recorded a podcast with a guy named Paul Ingray. I forget how long ago it was, probably a couple years ago now.
I was going to bring up his clock of fear, actually.
Yeah. So it was interesting about that. And then we'll put a link up to that show and the clock. So he recognized patterns. This is in the 70s or 60s even, I think. He recognized patterns in the response to crises. But his model for the preconditions or conditions of a crisis is just that people are scared. And they get scared because they don't recognize the environment anymore. And the fear in his mind gets manifested in people losing their jobs. And so until people are getting fired, nothing changes. Until people are feeling real personal pain. And I think that's just something that is so interesting and different. And we're just going to use kind of fairly dry academic terms of things like interesting, when this is a truly, I think, honestly terrifying environment we're in right now. I mean, my wife is pregnant. She's due in a couple months. And, it's another layer of fear. So from a personal standpoint, it's really distressing. And I think that once that happens, it's kind of now you're going to have something. something's going to change. Now, for the insurance industry generally, I don't think there's going to be much surprise. There's a potential of surprise. There's some press came out this week on governments kind of mulling over the possibility of forcing business insurers to cover business interruption claims.
Hmm.
And that would be a classic example of a surprise, right? So where the rule of law breaks down, and it does happen, right? So the Hurricane Katrina, post Hurricane Katrina, a lot of the, I think governments, I forget kind of the exact mechanism here, but they forced them to cover flood claims. And so that was something that was excluded in the policy. And that, that I think is underrated in the degree to which it shakes the feeling of like understanding for like the rule of law. I mean, the institutions of our economic society break down, like literally like the law says this and its contracts say that, and then we're just going to just wipe that aside and make you do something else. That's what really screws things up. And that's what really forces people to say, I don't understand here what's going on. And then they back off, and then the capacity pulls out of the marketplace, the prices go crazy. You have new entrants come in because, what they're kind of predicated on is the new entrant. They don't know anything more than people are leaving. What they do have, though, is they don't have a legacy of business to protect. And so they can be really, really tough and bringing the terms and conditions up on the policies. And as a result, as long as the rule of law holds again, so there's an assumption, implicit assumption, that whatever the original pain was, which is this, they call it degradation of the rule of law, or at least understanding of the law, that will restore itself, and then we'll have this recovery, which is what's happened to you, right? I mean, I think that whenever you've had some kind of breakdown in people's feeling of certainty of how the world works, that does get restored. There's kind of like a natural response from the economy, from the political institutions, from society, that just restores order. Like, as an example, when prices for insurance go up, people use less of it. And when they use less of it, they wind up having higher deductibles, and they wind up self-insuring more. They wind up being more risk averse. Sometimes it takes a long time for that to kick in. Another example from the Paul Ingrey interview, where he said, they were raising prices by 100% in like 1981, 1982, and the market didn't actually turn until 1984, 1985. So you had years of extraordinary pain before people, and finally light bulbs switched in their heads, and they're like, oh, we can't just keep doing this. And then people actually start pulling out. And so I think that it takes a lot longer than you think sometimes for people to change their minds, people to change their model for how it works. And I feel like I have this conversation right now with my wife and my friends and people in my neighborhood here, where, do you really believe it? Like, do you really believe that you kids can't play with each other, you can't go outside, you can't go to the grocery store, you have to wash your, like, I'm not sure it's totally sunk in for everybody. I think there's a minority, but like, you see I don't know if you watch CNN, but the kids are partying out in like whatever that place, Saint something Island in Georgia, until you see kind of behavior change like that as like an analog to the insurance industry, I'm not sure you get real change. And so you see signals of like genuine social change, like people are changing how they live and metaphorically how they work in the insurance industry. Like the assumptions of the past are no longer valid. That's when, you get something new, you get, an opportunity for those who are moving in. But you get a lot of pain for those who want to try and fix it in place or pull out.
So, when you're thinking about the current environment and the people you speak to in a work environment or just industry context generally, much like lots of conversations I'm having with people that work at other investment funds, there's just pretty widespread recalibration of the possible outcomes, right?
Starting to happen.
And so when you think about that piece, it's interesting that you kind of dove directly into this notion of basically, overriding contract law for the good of, I guess, social utility, and how that's kind of, maybe, I wouldn't call it a black swan event, but maybe the effects of a black swan event.
Yeah. That would obliterate the insurance industry. I mean, obliterate it. The amount of leverage that exists in an insurer's balance sheet is inconceivable. It's like, if you think like the average rate on a general liability policy for one of these restaurants or something, and they're spending, I don't know, what is it, $1,500, something like that. If that, and they're exposed for, potentially $1 million or more. I mean, that ratio is very large. And that's like, I think like the insurers, they rate their capital on premium. And so you're already sitting there looking at a few orders of magnitude more exposure on their balance sheet than they're even measuring. I mean, they don't measure it.
Yeah.
They don't even count it. Like, there's no point. The numbers are too big. It's like trillions and trillions. So as soon as you like flip the switch there and you think like, if whatever, like, I don't know what it's going to be, 70% of all restaurants in the United States could go to business, like it's going to be something incredible, like something incredible, right? I mean, it's so, the insurers it would wipe out every single insurance company. So it's almost like, they can't do it. They just can't do it. It's too big. It's too big. Like, insurers just be like, here's, you don't even have to have a sophisticated lobbyist. You just like, here's a little Post-it note. Let me just write a few numbers down for you. You tell me how this is going to work. It ain't going to work.
Yeah.
It's just too big. So like, we're protected in a sense there by how bad it would be. It's just too simple.
Yeah. I wonder, when you talk about or when people are discussing the government response right now from an economics perspective, you talk about fiscal stimulus in terms of emailing or, sending people checks in the mail, or, corporate, injections of cash like they're discussing with the airline industry. And I really wonder how it's going to work for the small business segment, 80% of restaurants plus in the United States. You could use the insurance industry as a bailout mechanism theoretically, right? If they're
I just feel like you need too much money. There's not that kind of money. Like, you can't replace the scale of, I mean, we're even talking about GDP right now, right? I think we're starting moving into the wealth conversation. So it's like stock of capital, it's not flow. So the flows are fucked. We know that. If, but I guess there goes the G rating. But the stock, we're talking about like credit risk. So now you're saying like, so what happens if you have the balance sheet of a bank exposed to so many loans? I mean, in restaurants, never were a favorite place to lend money for banks, but I think other businesses may be. And so, once you destroy that much capital, I just don't know that there really is a pot of money big enough to fill that. I don't know.
Yeah.
I mean, maybe you have a holiday on interest payments or something, and maybe that's something that can, preventing people from going to default, maybe as a way of doing that and hoping the rebound happens. But I don't know. What do you think? I mean, it seems to me that there's a huge systemic risk possibility here of a loss of confidence. People can pay anything.
I think that that is not, I think, in the consensus view. If you want to maybe draw an analogy to the financial crisis in terms of the, I guess you could call the amount of psychological fear people are factoring into their view of the world. I mean, if you go back to post-Lehman, the immediate aftermath was that the money market funds broke the buck. There were daily rumors about, if Bank of America was solvent, if Morgan Stanley was solvent. Like you're saying, investment professionals were thinking about, the viability of their career. You didn't know if your prime broker would be able to keep your financing lines in place or even have your, cash in the right bank. I personally know investment professionals that were moving bank deposits from Citigroup to Bank of America to get below the FDIC deposit insurance limit. And there's not that kind of worry that the banks are going to be insolvent. I would say, firstly, because, a number of things have kind of evolved in the credit market since. Some have been a function of natural market responses. Others have been responses to some of the regulations that were put in place after the financial crisis. And then just in general, if you just look at very simple leverage ratios, so, assets to equity, the banks are just significantly less levered now. So I don't think there's that systemic fear in the investment community today of, the idea that Citigroup would be nationalized and, what are the implications of that? Or if they're not nationalized, what are the implications of that? I don't think that's in the Overton window of stuff that people are talking about. But
What about
you know,
insolvencies though? Like for for regular businesses, because I gotta think that, right? I mean, one of the facts forecasts that has really hit me over the head in the last 10 days is just how long this could last. So we have this social distancing, don't go out. There's schools are closed, private schools, universities. I mean, surely many of these institutions, organizations have loans that they're just going to not pay back, right? I mean, I guess the hard assets are still there, but now we're talking about like potentially a downward spiral, right? Of who's going to buy that, and there's only so many distressed buyers. What do
yeah,
you
I
think about that?
think, I mean, in general, the way I think about credit cycles is that this one's very different. Most credit cycles are driven by an oversupply of capital over time, leading to a misallocation of resources. And then that misallocation of resources ends with a supply shock, leading to an increase in defaults and basically monetary tightening.
Mm,
Um, so Fed raises interest rates at the end of the cycle. Losses occur because the misallocation of resources don't earn their required rate of return based on the cost of capital of borrowing and equity, etc. Defaults tick up, lots of things go bankrupt, and we kind of start, and then Fed drops interest rates, etc., etc. So the financial crisis is an example of that, right? So you just had interest rates very low for a very long time. There's large misallocation of resources into housing, into stuff that was put on banks' balance sheets. And then after that all unfolded, you had a monetary response to that crisis, right? It was a monetary response to a systemic banking crisis. And if you think about it, right, the only way this crisis could have happened, given the Fed's knee-jerk responses to weaknesses in the system since, is kind of the way it happened, which is this, very black swan-esque exogenous demand shock.
yeah.
So what we're dealing with now is kind of that, I wouldn't say in reverse, but it's sort of like the economy is stopped. You're going to see, a sharp contraction in GDP, and then a significant rise in unemployment and defaults. But it seems, at least for the moment, that the uncertainty is based on how long this is going to last, and the duration of the shutdown, the threat of double dips, and then this idea that there will be these kind of blow up knock-on effects. So, to give an example, one thing people are talking about is that comparing this to the financial crisis in terms of these blow-on knock-on effects that have never happened before. In the mortgage-backed security market, no one had ever modeled a countrywide hyper-correlated simultaneous decrease in housing prices and the effects to all those mortgage-backed securities and related products, right? The analogy here is that in the crude oil market, systemic demand shocks have been of the magnitude of 3 to 5 million barrels. If you do some kind of back of the envelope math on contraction in miles driven, you could have a contraction in demand of 3 to 4 times that 3 to 5 million barrel.
Yeah.
And so, the way that plays out is that, storage fills up after the curve is in contango, and then oil is just, dumped on the market. The price contracts significantly, and that, every shale producer in the US goes bankrupt, and that has systemic kind of implications for the rest of, high yield credit and high yield loan markets.
And that feels pretty plausible to me. I don't know what's your kind of assessment of that story.
Yeah, I mean, so this is kind of something that seems plausible and you could follow the storage data. But maybe there are 4 or 5 other things like that that we're not, or at least for me, it's just not on my radar, and I don't understand. And so
Yeah,
the longer we stay in this kind of depressed state, the higher the chance that these things play out.
yeah, yeah. And I think that the difference between kind of like my model, if I could be more kind of a little bit more succinct about it on insurance shocks, is that they're primarily exogenous shocks. I think that, and
Yeah,
I think your credit model is an endogenous model, right? So you have within the system, you're kind of playing and playing and playing. You start messing up more and more and more, and then eventually get your bad behavior catches up with you with those insurance. I think that's a lot less common. I think you need, and this is probably, I don't think this is the majoritarian view in insurance. I think people probably like the idea of your model for insurance as well, although I just don't quite buy it. I think that it's only because I've just seen so much of everybody else is an idiot kind of behavior, and I think that really plays into that bias of, it's easy to blame the idiots, who right, who then are causing the crisis for everybody else. And there is a certain kind of like, everybody does have to move in the same direction in order for this weird kind of like collusion to work. And when you have forecasting based industries, if somebody
yeah,
messes up the forecast, then they can put on a lot of business at underpriced numbers. But when I look at history, I see actually the real bad ones happening when something crazy happens,
yeah,
asbestos, right? Or the institution of strict liability, the real enforcement of that in the 70s, inflation as well, and then you have 9/11, you have asbestos kind of reboot around 2000, which is underappreciated, which happened around then too. There's a big insurance hard market that happened then, and you have some kind of systemic game playing happening there too, but it wasn't anything like the asbestos crisis, which is, so you think maybe this is kind of an insurance style recession, if you can call a hard market a recession in the insurance business, that happened to everybody, because you have this kind of this meteor hitting us from outer space, and now what happens? Everywhere I read is just like, this is so different, this is so different, this is so different, this is kind of breaking the model for a an economic crisis. I
so
agree.
so maybe this is a point of differentiation. So and correct me if I'm wrong. So my understanding that a lot of like the life-oriented products over the last, we've discussed this before, but in the late 90s, early aughties, people were modeling mortality that turned out to be, I guess, different, and um, a lot of multi-line life and health insurance companies were looking to divest their large books of annuity products and stuff like that. So that seems like a more endogenously driven. Oh, that this sub product in the industry is just the returns based on the capitalization today are just unattractive. So either you have to take a risk and recap that business or exit that business. And then there's stuff like asbestos where there's a contagion effect. So there's just mass pain, and that causes a hard market across. And so these pricing dynamics for policies, there's a contagion or correlation effect. Is that
So I
yeah,
think what happens when you have kind of like this disagreement, the herd mentality problem,
yeah,
what, when everybody, the herd sort of directing itself over the cliff, right? Is this kind of the problem, is sort of a way of thinking about this phenomenon. And I think that you still have a bunch of people opting out, and smart people saying, you know what, you guys are idiots. I'm not going to do this. I'm going to get out of this business. I'm going to exit. And a lot of organizations do that. The biggest ones tend to not, because they sort of have to, they're all indexes,
yeah,
right? But I think there's enough smart money that sits on the sidelines waiting for things to change. And to me, that's a real cushion, right? That's the net that's getting built underneath the trapeze artist. But when you have an exogenous shock, you don't have that, because nobody saw it coming. Maybe it gets the weirdos and the cranks or something like that, but they don't have any money. They don't have any influence, right? And it's the stop clock, right twice a day. I think that it's indistinguishable from that. Your kind of perpetual bears are always going to be there. But the real shock, the one that, and maybe this is a magnitude of response definition problem here, where it's like, when I'm thinking a hard market, I'm thinking one that's like, for real, right? So
Yeah.
what happened even after Hurricane Katrina, which was pretty surprising, it didn't affect the lines of business that were outside of the domain that got shocked. So you have coastal property insurance, bad couple of years for them, for people buying that insurance. Great couple of years, people writing it. But the other lines of business, didn't even notice it, shrugged it off. And I think that to me is a localized shock, and that's not something that's worth putting in the model. I think that because enough smart money will exit when they feel like things are doing stupid things, the market's doing stupid things, they're just waiting to come back.
Yeah.
And I think that's much more the pattern we've seen over the last 15 years in the insurance business, where you have people kind of always coming in and out, always waiting for the next turn, because I've noticed over the last few years many specialty insurers who are super smart, who are super conservative, who, I don't know how people are making money here. And so they hired a division of just build a base of premium. It doesn't perform that well, but that's okay. We got our toe in the water. We're waiting for the turn, is what their strategy basically is, and has been for, a generation. And it didn't come. And then eventually they get kind of bored, and they just close down, bored of losing little amounts of money for their, size of organization. And they just close down those little divisions. They'll start up again in a heartbeat. Right. Because they have this kind of, the marketplace is just generating this diversity of opinion, because it's a no, right? It's like, I know that we don't know what the price is, but I know that that's a problem that I'm trying to solve, of like, how do you rate the price, and what are if I look backcast over history, I have this sort of bunch of examples, and if anything like that happens, I'm ready for it. But it's like the meteor from outer space thing is the one that nobody's really ready for. And you can't, there's no way to do it. There's just no way to do it. No way to, because at that point, it's like, it's very easy to just sort of, be terrified of everything. And then you will do nothing. And that's just, you have to participate in the marketplace. You have to choose somewhere to be. Once you get to the real fantastical kind of, stuff like this, like, if we talked about this 6 months ago, maybe you have people in an insurance company that would have talked about this problem. But nobody would have said, oh, wow, that's something we should really be worried about. Maybe even they were wrong anyway. Maybe the insurers don't have anything to be worried about, which I think is probably the case. Like, I think that we're talking about something like a big event cancellation insurance, massive problem there. But that marketplace is tiny. It's like a sub $10 billion event for the insurance industry, which is, it's no big deal at all. It's nothing. It's nothing.
And so are most, business interruption insurance policies written with, basically exemptions for pandemic exclusions and stuff?
Yeah, well,
like
they're designed to be property covers.
Yeah.
So it's like, if your building burns down, is like the canonical original example, then we're going to pay for your inventory and pay for your lost revenue for a period of time. Or if you get hit by a hurricane, earthquake, that kind of thing. If your employees all get sick, or if the government tells you to shut down, that's just, it's not contemplated. It's not even like it's not even in the insurance kind of like vocabulary, that kind of thing. I guess it's not property, it's not liability, right? It's not like somebody harmed you. It's not part of the tort system, right? The mechanism for paying here. And so there's no category of coverage. There's no insurance industry that's designed to do this. Like, it falls into the catastrophe realm, because you have this kind of contagion effect, right, in the kind of general sense of the word, or this, one cause hits many different coverages. But no catastrophe policy is going to ever include pandemic, because they don't have any way of modeling it. And that's partly a hunch, partly based on some press I've read, partly based on some conversations I've had in the industry. I haven't done a thorough kind of review of any of this, but the absence of conversation about it within the insurance world is pretty indicative. If this was anywhere in any business interruption ISO policy, the insurance industry would be wiped out, and they're not.
So where does the say there's a situation or a scenario that you alluded to earlier where, contract law is broken based on government intervention, what policies would be triggered, I guess, by that?
It would probably be the general liability or package policy for a small business. Anything it's business interruption is the coverage that it would hit. And so that, like I said, tends to be on a property policy or a blended policy. You know, there is some like liability based business interruption, like contingent business interruption. That's pretty rare and pushed
Yeah.
back on pretty hard by a lot of insurers. Some industries will have it. You know, typical case there is like an oil refinery or something, right? So, you know, if for whatever reason the refinery blows up, then the gas distributors or whatever it's going to be, you know, they have a big problem. But it's corner little not systemically important part of the business.
So what you're saying basically is that, you know, if the industry will take material losses, it would just be in this way that would be, you know, kind of unprecedented, versus, oh, there are these specific pockets of the industry which would be, I guess, analogous to the, you know, Katrina example with coastal flood.
Yeah, it would. The one part, it, you know, the one place that is a little bit of a wild card is the health insurance business,
Yeah.
which is the business that I'm in now. And you know, the health insurance industry is kind of weird because it's not really insurance. A lot of it, you know, kind of major medical policies is much more of a prepaid medical plan, and it's not like it presents a, you know, like for the magnitude of fear, it's not like it's like really expensive. Like you'll go in the hospital for a couple of weeks and then you'll kind of recover or not, right? And that's only 2 weeks in the hospital, right? The really expensive medical insurance claims are like the hemophiliacs, right?
Yeah.
Like they survive for a long time with requiring humongous amounts of expensive care. And so, you know, here you don't necessarily, I mean, it's very expensive, of course, to go get admitted to the hospital, whether you know it or not. I mean, insurance companies paying piles of money for that. But you know, to me, it's you know, I haven't really considered the calculations on it, but it's going to be a bad year for those organizations, I think.
Mm.
But I haven't seen a lot of evidence of it being like a calamitous year
Mm.
for them. And in any case, I think that you know, there's a weird interaction with the government here where I don't know what the government's going to wind up paying for.
Mm.
Um, you know, especially since, I mean, it's still pretty early, I think, to figure out, you know, if you have like, if you're going to quarantine, you know, who kind of pays for that, right? If you're sort of a government imposed quarantine, you know, it seems to me that I think there's, you know, I don't know enough about it yet. It doesn't seem to me like it's going to be a massive problem for you know, the uninsured, right?
Yeah.
That's going to be picked up by the hospital systems and the government because they can't no
Refuse.
insurance company's
Yeah.
going to pay for
Yeah.
that. So it's hard to see the mechanism for you know, big changes to the health insurance industry here.
And you know, if you're a business, just, you know, either a large corporation or a small business, and your policy is coming up for renewal, you know, at the end of March 2020, it has, you know, has the pricing inflected already, or it's like, you know, what do you do?
I haven't seen it.
Yeah.
You know, you know, let's say like I haven't been really keeping up daily. So this is
Yeah.
right. I mean, as you know, as we all know, this is every day is different kind of thing. So, you know, business just doesn't move that fast. Right now, there's a lot of, I think a lot of companies are just trying to delay stuff. So
Yeah.
you know, let's just wait and learn more about what's going on, gathering some information. There's no precedent for it. So I don't know that, you know, a lot of the insurance industry itself is going to be in trouble from on the revenue side, right? So if you have the huge economic collapse,
Yeah.
that is still the drivers for all the insurance premium calculations are
Premium
revenues
policy.
or
Yeah.
employees in place, right, for workers' comp, or miles driven, or sorry, not miles driven, but vehicles in force, but miles driven is kind of the implicit one there. So I think you're going to wind up seeing a gigantic reduction in revenue for the insurance
Mm.
industry, but a commensurate reduction in exposure. And there's going to be some, you know, messiness in that relationship between exposure and the rating basis for the insurance policies. That, you know, that to me is why the
And you
stocks are
know,
down.
and potentially an offset for the, you know, if miles driven is down substantially, your policies in force, the loss ratios are likely to be much lower, right?
Well, yeah. So I've seen it go both ways.
Yeah.
I've seen I've seen like, as you have this measurement, this proxy for exposure, right? So for like miles driven, let's say, or it's going to be revenues for a small business or whatever it is. And I think that tends to get calibrated and work fairly well within kind of the known history, right?
Hmm.
It's not a true measure of exposure because you have all these other, exogenous effects, right? So like, your miles driven, right? And if you were like a truck driver right now, driving thousands and thousands and thousands of miles, you'd probably be okay because you're the only one, or
Yeah.
whatever it is, right? And so whenever you kind of head out into the tail of the distribution here of the rating basis, you just don't know what you're going to see. And financial crisis presented another example of this, where I've seen companies be surprised at how low their loss ratio is, and I've seen companies be surprised at how high it was. And the
Yeah.
same within this, it's only because it's just hard to predict. I don't know whether it's this, the error is symmetric or not. I'm not sure, but it's hard to tell.
And what about how does the brokerage industry respond? Obviously, my dog decided to butt in on the question.
Didn't like the brokers. Not alone.
But so churn goes up because unfortunately some of your customers are filing for insolvency.
Yeah.
But how does the mechanism work in terms of the prices inflect? Do their profit margins go up because of the price volatility or because prices are rising? Like, how does that?
There's two kind of important measures here for the business at a broker. You have deal count, you have deal size, right?
Mm-hmm.
I mean, if your deal count goes down, that's bad because now you're overstaffed.
Mm-hmm.
If your deal size goes down, that's bad too. But it kind of a little bit of a different kind of bad. The way that their margins expand is they do the same work and they get more money. And that usually happens when you have a price inflection in the marketplace. And then they're just same guys doing the same work, gals. And now the prices have all gone 15%. Boom.
Yeah.
You just get a raise. And it's a kind of almost an inflationary sort of thing.
Yeah.
And here you're going to see a deflationary shock where you reduce deal size and deal count. So their margins are going to they're going to collapse. And the problem with the deflationary price sense, so if their client count doesn't go down, that means that they can't reduce staff, and so their margins are going to collapse all the more because you still have same work, less money. And
let's say if your deal count and your deal size go down, but the pricing goes up, the pricing acts as an offset to the former two. So the former two work against you because you have negative operating leverage, like you're saying. So you just have staff and costs. But the question is like whether that price inflection offsets the former.
Yeah, well, I mean, I think the price and the deal size is being basically identical, right? So the price goes up, that causes the deal size to go up, because the brokerage, the intermediation there is like your brokerage percentage, and that's not going to change.
Yeah.
So if prices fly up, then they're a good day. But
yeah, so net on those two, you think the net result is negative?
Down. Yeah. Down arrow on both. I think deal size goes down because companies go bankrupt, and I think deal count goes down because companies go bankrupt, and deal size goes down just because you just have less economic activity.
Understood.
Yeah, so you'll see layoffs, and then but at the same time you'll see there will be, I suspect, more the margins will the margins after the fact are still going to be worse.
So one thing I've observed in the brokerage industry is the success over the last 20 years by someone like Brown and Brown, has been noticed and replicated with lots of balance sheet leverage by I think 6 or 7 different private equity funds. The result of that has been more competition for deals to roll these guys up, probably more competition on pricing. Do you think this catalyzes a reversal of all that if one or two of these guys go bankrupt?
Well, leverage introduces fragility. I mean, I think that I think it's important to say too that this is all really contingent on kind of what the full year GDP level looks like. Because if you have
Yeah.
the sharp drop and you have the sharp increase at the end of the V recovery, that happens pretty quick, which is, I mean, as far as I can tell, pretty plausible. Because once people just start going back to work, I mean, I'm not sure what it looks like exactly. Tyler Cowen talks about the destruction of intangible capital, and so to me, what that really means is that's just like the quality of the businesses that come up in Q4 are less than the quality of this.
Yeah.
The restaurant food won't be as good. There's going to be other kind of a little bit less trivial consequences in that, but I still not sure. I think that kind of reduces, let's say, consumer surplus or something, right? But I don't think that necessarily reduces a lot of economic activity. So I think that a V-shaped recovery feels pretty plausible. If that happens, then you kind of have this dip and up and again, and then feels to me like it probably might not matter too much, which is maybe that's what the credit markets are pricing in right now, right? They're just thinking, they're saying, well, with the strong V recovery, then there is no credit, credit crisis, and we're probably okay. Or am I breaking up? You hear me okay? Okay.
No, you sound okay. I mean, well, I'll tell you from my vantage point, the typically in those private equity structures, for the large brokerage roll-ups, they were financed like a lot of private equity buyouts with like a first lien, second lien structure. And the first lien, say creates the company for 5 to 6 times EBITDA. Second lien creates it for 9 to 10 times EBITDA, with the implication of the equity check, valuing the total business at say 12 to 14.
Right.
And so it's very difficult to under a normal distribution of contraction and economic activities to see that first lien bond being impaired, whether it's bond or a loan. But today those are trading at let's say in the 80s. So whether that's because of just wholesale credit liquidation, which it hasn't been as bad as the '08 crisis at all in any respect, but there is some uncertainty being priced in.
Yeah, that to me is an interesting indicator. And it may be, the kind of whatever the credits. I mean, I'm not sure what the right comparative indicator is between the credit market and the equity market, but to me, like that might be an interesting proxy for how long the market thinks this crisis is going to last. Because if the crisis is short, you could still see equity returns be bad, but bond returns be okay, right? But the crisis is long, then I think the second shoe to drop is the credit just freaks out.
Yeah, I mean, if you look at this chart of between U.S., EU, and emerging market sovereigns, what you see is this kind of correlated lines going over time, and this is measured in yield spread to treasuries. So at the peak of the crisis in '08, in U.S. high yield, there was like 2,000 basis points of yield spread on U.S. high yield, and today we're at 800. So that's far from a perfect and all-encompassing indication, but it shows you at least where we are today.
And so interpret that a bit more for me. So that spread drop, what does it mean?
So let's say in a quote unquote normal environment, high yield trades at like 4 of the 500 basis points above treasuries. In the last few years, those spreads have been very, very tight, going to, let's say, 200 basis points above treasuries. If we're looking at treasuries as basically like, let's say the 10 years 1 to 4% over the last 10, 15 years, that's the yield to worst at the high end of 24% IRRs on investing in high yield credit at the height of the crisis. At the tights, say like midway through last year, you're getting paid like 4 or 5% a year to take that risk, and today we're kind of like 9 to 10% a year.
I maybe misunderstood your point there. I thought you were talking about the difference between the international spreads and the domestic spreads. Um,
I only meant to say that, they're vastly all correlated.
yeah, okay, and that hasn't changed.
Not really. I mean, you see little quirky stuff going on. For example, EM sovereign credit is kind of at the same yield spread where it was in 2008 today. And there are lots of different hypotheses on why that is in terms of the increase in market capitalization and various fund flow things. But by and large, they're very correlated.
How about term spreads? Like, how about like what about forecasts for the future? One of the things I'm just fascinated by here is like, what does the future look like? And any kind of like any market prices that can predict the future for us here, like the 5, 10-year, 30-year, that kind of thing.
I don't know. I mean, I tried to personally take it the other way. I look at when there's stuff in the market that doesn't make a lot of sense. I look at that as kind of like, okay, we've reached a real point of either fear-driven or mechanistically driven liquidation.
Right.
I mean, one reason why I'm kind of interested in what's going on in insurance is that, for example, you could look today at Arch Capital preferreds are trading at a meaningful discount from par, and that tells me that there's market signal pricing that tells you that there is a reasonable chance that there could be very deep distress in the industry.
Yeah. Well, what's funny about that company in particular is the mortgage portfolio that they have, and so I wonder if there's a housing market kind of disturbance there potentially.
I mean, in general, it seems I guess I'm more optimistic on the asset side of the balance sheet for these companies, with some exceptions. Yeah. I guess, a lot of them had kind of negative experiences during the financial crisis and having not necessarily permanent impairment of capital, but more just, I thought, we could get our money out of this thing when, times were rough, and now you're telling me I can't.
Mm-hmm.
Yeah.
Yeah. I think that one part of the insurance industry that I think that will not change here is I think that kind of how the insurance companies will respond, which is to say they're going to exclude it. And I think that the classic pattern of behavior is we won't touch this or maybe any future pandemics for a period of time. And I think you're going to wind up with probably some kind of government issued, like TRIA, this Terrorism Risk Insurance Act after 2001. And I think that pandemics are just going to be hands off for insurance companies for a while. This looks to me like a once in 100-year kind of event, right? This sort of thing. And maybe society will self-correct.
But if I'm either a small business or a corporation with very direct exposure to the contraction of economic activity, so restaurants, airlines, casinos, etc. Do I, at the encouragement of my lawyers, just file a claim as basically a call option at this point?
Probably. And then the insurers will just kind of as kind of a matter of course just deny it. I think there's going to be a little bit of legal theater that goes on with that, which doesn't wouldn't surprise me in the slightest. Yeah, there's going to be lawsuits that will hit the court system, but to me it's all pretty straight up and down stuff, unless the government puts some legislation through that blows everything up. But
so if you're a balance sheet provider, do you provision for losses at this point? If those claims come in, or is it just kind of
no way?
TBD?
But I don't think you do. I don't think you can. And I think that even there's this funny kind of like dance that happens on the claim side where they don't often want to, because then that's like a pre-admission of
Guilt.
guilt. Yeah. They're saying, well, you put the reserves up, that means you must think this claim is valid. And they're like, well, different department, and like, nah, it doesn't work. So I think that they got to hold the line on that, because if that dam breaks, it's over for everybody.
Yeah. So I guess like, what you're saying is basically net, you're saying, small stuff like event interruption insurance and that, we shouldn't, and then the general just economic effects of lots of your customers are basically going bankrupt. That's the real problem, I guess. Not that there should be these ballooning liabilities, except in this, uh, tail kind of event where the government steps in.
Yeah,
Right.
this is not an insurance crisis. This is like an incredible real shock to the economy that
Yeah.
that will have implications for insurance, like it does for many other businesses, um, but but not anything beyond beyond that. And I think the credit markets are the ones that to me is the thing that could really make this thing a whole nother level. If
So asset side impairment, basically.
Yeah, I think that, yeah, that's right. So the asset side impairment for the insurers, and then also kind of the consequences,
For the real
for
economy. Yeah.
yeah, for the real economy. And I think that it's like the employees of the insurers. You hear all kinds of stories where people, like friends of friends who own businesses, and they don't know what they're going to do. Right? I mean, I think that a lot of people are going to have a real problem on their hands. The longer that lasts, the compound, it's going to be a compounded effect.
And if you were starting a insurance business, say, where is there something, there's clearly going to be a dislocation in this market for the next 3 or 4 years, and like I could earn excess returns. Is there something kind of maybe obvious or not so obvious
I
that?
don't see it yet. I don't
Yeah.
see it yet. It's one of the things that I'm studying pretty carefully right now myself over the next, hopefully, couple of weeks, maybe longer. Um, that folks can subscribe to the show and follow me along with me if they'd like. Um, but that is the main thing I'm trying to figure out.
And that would be, and what you're watching, aside from, people just literally getting fired and losing their jobs, is the price signal that you
We
noted
have price
before.
signal, availability, which is availability capacity. So it's going to be,
Yeah.
what I want to be doing for the next little while is talking to people in the business, on the front lines of a lot of these different lines of insurance business, and seeing whether they're sensing any kind of unusual distress. And I don't have a way of predicting that, anticipating that. I don't see it myself, like just reasoning through it.
Yeah.
Doesn't seem like it's going to show up, but I feel like I'm pretty humble about what I think I know about that right now.
Yeah. And it's interesting because I don't know, a lot of financial market data is um is available to all, or all qualified uh, by being able to afford a Bloomberg or something.
Right.
It's just like, where you choose to put your attention, I suppose. But with this, it's a little, both the pricing and these kind of, let's call them informal pricing signals. The data is just a lot less transparent.
Yes, it is.
Yeah.
The data is not very good, and it
Yeah.
takes a little while for it to emerge. I think that, um, yeah, I think that's why you got to talk to people, right?
Yeah.
Because that and I mean, you'll see there's enough earnings releases and stuff that companies, if they're pulling out of something. So if
Yeah.
if the insurance company votes with its wallet and says we're pulling out of this business or that, and we're going to issue kind of earnings releases, kind of like, we're going to reduce our forecast for premium written. That kind of thing will hit the financial markets. So these big insurers are, they're probably traded, and so they make decisions about it. They'll know. To me, it's like the more interesting question is, what about the world will be different? And I think that, there's a few things that I feel pretty confident in. I think there's going to be more remote work. I think there's going to be a lot, and a lot of insurance is done face to face, which is interesting and maybe change the kind of company that's successful in the future. And I think that you're going to see a different kind of, I think, different behavior. I think that I think this could scar this generation a little bit. And I mean, our generation, Michael, I think that, we might make different decisions about how we live our lives in the future, depending on how long this lasts and how bad this is going to get, because we're still at the beginning, right? I mean, if like 1%, 2% of the population dies as a result of this, like, man, that's like people,
Yeah.
man, right?
Yeah.
So, and that, I think that it'll definitely, politics will change. I think that, there's a lot of stuff that could be different about the world in 2021. And I don't know them yet. I'm trying to figure them out. And, they will have an impact that we will not expect on all businesses, and I think including insurance.
Yeah.
Stay tuned.
Yeah. I think is that a good point to wrap up on?
I think maybe it is. Yeah. It's dark, but it's dark right now. I mean, I think that, when we would be positive, a little bit positive, I think that ultimately, I am personally trying to remain positive about it. The personal situation is difficult, like it is for many people. But I think that I believe in our ability to figure something out, deeply, but we just got to see what that's going to be.
Well, that chart that I alluded to before with the high yield credit spreads. So if you look at, there's no time in history that if you start at a level of over 800 basis points on a forward 2-year looking basis, you've ever lost money.
Right. Amazing.
So, we're getting there.
To buy long-term credit or buy, there we go. There's a money-making suggestion. All right.
I mean, yeah, don't hold me to that.
We'll put a link up to a chart. Okay. Thanks a lot, Michael. Appreciate you getting together with me on this, and we'll put a link up to this that you can share maybe, or, we'll talk to you later.
Thanks so much, Dave.
See ya.